Okay, so we have now heard from Jerome Powell and the Federal Reserve as to the changes that they made to the federal funds rate today. Today is February the 1st, 2023. It is now 3:49 p.m. Central Time. The bond market is almost closed for the day. The mortgage-backed security market will also close today at 4 o'clock Central Time, so we're almost there. We now get to see the results of the movements by the Federal Reserve to the federal funds rate. Now, they did raise the federal funds rate by 0.25%, which is what we wanted and what was anticipated. But if you really watch the interview, the key is the comments that you heard from Jerome Powell during the press interviews after the fact, and really trying to read his body language as to whether he feels that inflation is subsiding as quickly as he wants it to. And in looking at that and watching it closely, it really did appear to me that he does feel like inflation is subsiding and that things are going according to plan. However, the media really wanted to press him on the fact that when you look at the comments that were written and actually put out by the Federal Reserve as they made this announcement, they actually put it in writing and they put some comments in there. They talked about the federal funds rate still having the ability to increase. And they made it kind of sound as though it was something that could be plural. Like you could have more than one movement in the federal funds rate in the future. Now, we want the federal funds rate to come up by another 0.25%. That's something that we expect and that we actually want to have happen in order to feel comfortable that we are going to put inflation back under control. But when you leave the door open for multiple increases, that's what the bond market really doesn't want to see, because that indicates a discomfort with the level of response that the market has already had to the federal funds rate, and that they may have to make multiple adjustments to get inflation under control. Let's take a look and see how the markets are responding. We take a look at the mortgage-backed security here. We're up 30 basis points on the day, which is great. That we were up quite a bit higher earlier in the day, came back down to where we were back into the teens, and now we're getting close to ending the day, now up 30 basis points. The 10-year Treasury is also really responding in the way that we want it to. We're down 13 basis points on the 10-year, now sitting at 3.404, which is just a tremendous improvement from just a couple of months ago. We take a look at the charts here. You can see that we did break through the Fibonacci level, which we've been trying to break through for quite a while. And we even banged up against the 200-day moving average, which is the fight that I've been talking about for a number of days and even weeks now, that we want to get into a fight with the 200-day moving average. You can see that we did bang up against it, and it won the fight today and shot us back down at one point to the Fibonacci level. Looks like we're going to end up being somewhere in between this Fibonacci floor of support and the 200-day moving average as our new ceiling of resistance, which is where we want to be. This is a good thing to see. Let's take a look and see how the home loan interest rates are actually responding to this news. Let's take a look at our scenario here, which is the Brent Bruce Daily Variable Qualified 30-year fixed conventional home loan, 800 FICO score, 25% down, single-family residence. So we are currently sitting at 5.875. Now, yesterday, we ended the day at 5.99, but I was talking in detail about the fact that I believe that is because the market was getting ahead of good news that was expected today. And as you can see, we did get that good news. It came in exactly like we wanted it to. The bond market has been appreciating that. And now we are at 5.875 with a little bit of a credit, $277. Now, I believe that is the first time in over 8 months that I've been able to give such good news in any one day, that we are now looking at a 5.875 with no cost. So let's take a look here at opening this up and see what 1 point will get us. If we were to pay a point, just under a point, actually at 0.862, we're at 5.49, 5.49%. That is great news. We're starting to look even into the 5.375s and the 5.25s as not being that far away from where we are right now. And that is exactly what I mentioned yesterday. Things are moving in the right direction. That is great news to see here. Thank you very much for hanging out and listening to the comments and the expectations yesterday, and now seeing it follow through really exactly as we had planned. We always have knee-jerk reactions as soon as we hear that kind of news, and we really do have to wait and see how things wrap up in the next couple of days to see if the floors and the ceilings are going to hold, and then we will continue to battle that 200-day moving average. We have to break through that next ceiling of resistance before we will be able to get more into the mid fives and maybe even down into the lower fives without any costs. Let me know your thoughts. Make sure that you like, subscribe, and share, and I will talk to you again tomorrow.